Good afternoon. Thank you everyone for joining us today. We will be getting started in just a few minutes.
Good afternoon, everyone. Thanks for joining us today for practical and tactical actions for small business owners. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged in the entire video portion of the webinar program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CFP, CIMA, CPWA, CIMC, RMA, CPE, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. Now let's get started. We are joined today by Kate Blake, instructional designer and technology trainer at Fintegra. Kate has been with us since the beginning of her career, where she started in the retirement benefits field. And being the quick learner and talented contributor she is, Kate quickly arose into various positions within Fintegra. Kate's been able to exemplify her deep roots of industry expertise in each position she's held, and her skills have always been the perfect complement to Fintegra. Kate, now I'll turn this over to you to start talking practical and tactical actions.
Great. Thank you so much, Jen. And thank you, everybody, for taking time out of your busy schedules to join us today. I know we are heading into summertime and vacations are in full swing, so we're happy to have everybody here. Before we get into the meat of today's presentation, I'd like to briefly cover our agenda along with some learning objectives. So when we're talking about practical and tactical options for small business owners, what are we really talking about? Well, how can we keep more of what small business owners earn? What do small business owners need to know about Secure Act 1 and 2.0, and how can we, as professionals in the industry, help them obtain that knowledge? What's up with state plan mandates, and how does that impact our day-to-day retirement plan life? How can small businesses limit liability related to their company's retirement plan? How can they take better care of key employees? That's a critical component of the recruitment and retention aspect of benefit programs. And lastly, how do I, as a small business owner, create a better, more productive workforce? Now, I think our audience today is largely advisors who work on these plans and CPAs. So what I would encourage you to do is keep this list of questions to ask to the small business owners that you work with to help frame these discussions. We also have some learning objectives for today. We talked about some business goals on the prior slide, so I'd like to help you help educate your clients on how to achieve their goals using some of those ideas. We already talked about Secure 1 and 2, and we'll hit on some key provisions of those pieces of legislation. We'll also talk about plan governance, executive compensation, and financial wellness, and how all of those aspects can help us achieve some of those goals listed on the prior page. So let's go ahead and dive in. Number one, how can I keep more of what I earn as a small business owner? This is probably one of the number one concerns that I see from small business owners who are contemplating their futures, contemplating their benefit programs, and specifically retirement plans. And while there are several strategies for this, one way is through maintaining an optimal retirement plan that serves the needs, both financial and demographic, of the small business owners that we work with. So what can we do to help facilitate this? Number one, and most obviously, we want to help the small business owners that we work with achieve the ideal plan design. Most small business owners are really largely unaware of the various design options available to them. And over the next two slides, I'm going to show you a couple of charts that you may want to screenshot or review in the recording later on, because it really summarizes the different options in a nice, user-friendly way that I think could speak to the small business owners that you work with. I think it's important to let small business owners know when we're having this conversation that plan designs can really range from individual retirement-based accounts like individual Ks, simple 401ks and IRAs, to institutional plans such as DB and profit-sharing plans. And we can even get exotic with some of the provisions if we want to target benefits towards specific employees or groups using rate groups and or new accountability rules and testing. More on that in just a moment. In order to help point our clients in the right direction, though, the last bullet point I think is key, because I think we need to understand business cash flow, employee demographics, and owner objectives all together in a holistic picture in order to make the appropriate plan design recommendations. So here's that chart that I alluded to, the first of two. This chart is simply just showing the options that are available, along with who can establish, who contributes, the maximum employer deduction, and the maximum potential per participant contribution. So the way that this chart is organized, as you can see here on the left, it shows our IRA-based plans, including the SEP, Simplified Employee Pension, which is available to any business, but only has employer contributions, but does have some pretty high contribution limits, to something like the Simple IRA, which is available to businesses with 100 or fewer employees, a combination of employer and employee contributions, but it has slightly lower limits. So you can see, just looking at these two plans, they each have pros and cons. So I think sharing a chart like this with a small business owner can really help them not only identify those pros and cons, but also put them in the framework of their own business needs, as we described on the previous slide. And then, of course, we've got our qualified plans, 401k with or without profit sharing or other employer contribution components, our 401k with salary deferral only, which I see is less popular these days. Typically, your 401k plan usually has some sort of profit sharing or employer contribution component in it, but it certainly doesn't have to. And there's always the option for defined benefit plans as well. You may be thinking, DB plans, aren't they going the way of the dinosaur? And we have seen a sea change in the DB world over the last several decades. But I do believe in some ways and with certain employer types, that picture is changing, specifically with respect to cash balance plans, which we'll spend a good amount of time discussing today. Cash balance plans, as you may already be aware, are a hybrid type of DB plan that combines kind of the best of both worlds between our defined contribution arrangements and our DB plans, typically with lower costs for an employer. And as we have headed into this rising rate environment, which for anybody who works on these types of plans knows it lowers plan liabilities, these type of plans may become more attractive to employers, especially small business owners. Here's another way of viewing the chart. So on the last page, some of the key things to think about were who can sponsor, who can contribute, and in what amount. This chart is showing the different types of plans in a different way. And as you'll notice on the left-hand side of the page here, it's organized from lowest to highest contribution limit. I think that cost is a key consideration for employers when we're considering plan design, but how much do you want to contribute is just the tip of the iceberg. We can also ask our employers their thoughts on fixed versus variable contributions. So are you looking for discretionary profit sharing based on your budget needs each year? Or do you have the ability in your budget to contribute to a fixed contribution? All important things and questions for us to raise to the small business owners that we work with. There are also other considerations that are outlined on this chart as well, like how fees are assessed. So, for example, an employer who requires fixed costs for budget reasons, but wants to minimize administrative fees, might opt for a plan like a simple with a 3% match. Conversely, an employer who prefers more flexible contributions could also enjoy the higher contribution limits that come with a SEP or standard 401k plan with or without profit sharing features. So while I think these charts are really helpful and I think that they are useful for you all going forward, I think that when we share this information with small business owners, we have to give them those prompting questions. What is your cost consideration? Are you looking for an individual or a platform-based plan? Are employees interested in maxing out their accounts? By asking them those questions, when we show them these charts, we can help guide them through the process. So I mentioned cash balance plans, and I said I was going to talk a little bit more about them because, I think many of us are familiar with our standard 401k plans. But as we see this movement in interest rates and as cash balance plans start to gain the attention of many different types of employers, we thought it was worth another look today. So you may have noticed that on the previous slide, the cash balance plan was the one with the highest contribution limits. And some of you may already know, as we said already, this is a hybrid plan. It's 100% company funded, so there are typically no employee contributions in this plan, in a cash balance plan, but it is portable in the same way that a 401k or profit sharing plan is portable. So again, it kind of combines the benefits of our DB plan and our 401k plan. And if I was an advisor or CPA guiding my small business owners, I would make sure to share these pros and cons with them to give them a complete picture about what this is, how it works, and why they might want to consider it. The company guarantees eligible employees a specific benefit with a specified interest crediting rate. So the hallmark of a DB plan is we have a sense for how much we're going to get in retirement. The hallmark of a DC plan or a 401k plan is we know our account balance today. Defined benefit plans combine those two features by having a defined benefit formula, but also expressing benefits in terms usually of a lump sum, just like 401k plans, which is what employees are typically more familiar with. The other nice thing about a cash balance plan is you could make use of cross-testing methods, which allow companies to skew benefits to specific groups. So what you can do when you have a cash balance plan, especially if you have it in combination with a 401k plan, you can give benefits in a cash balance plan that are targeted towards, as you can see here, specific groups, provide them with very large contributions that we saw on the previous page. Now, a standalone cash balance plan may have some testing issues if you are targeting benefits toward a specific group. But combine it with a 401k plan, and now all of a sudden, you may not have testing issues, and you may have a more robust program providing both a defined benefit amount so we know how much we're going to get in retirement, plus the flexibility of a 401k plan. So if you have small business owners considering a cash balance plan, I typically would encourage them to consider it hand in hand with a 401k plan, both for the testing benefits that are mentioned here, more likely to pass testing, especially if you're gearing benefits toward a specific group. And also the 401k plan, of course, gives your employees the opportunity to defer out of their own paychecks, which doesn't exist in the cash balance plan. All right. So a little bit more on the nuances of how these plans work, especially if you're thinking about considering or, thinking about recommending your small business owners start these plans from scratch. First, you'll need a TPA to administer the plan and an actuary who will analyze the plan data and the demographics to create an ideal plan design. A big consideration with DB and cash balance plans are the ages of your employees, because certain types of benefits can benefit certain age groups. In a cash balance plan, all your standard provisions that you see in 401k plans like eligibility, investing come into play. But one difference is that the benefit formula will also need to be defined in your cash balance plan. But it's kind of like how you define an employer contribution in, a match or a non-elective in a 401k plan. In a typical cash balance plan, your benefit formula will usually take the form of a service credit, which is an annual contribution, typically based on earned income, along with an interest credit. One difference and additional work step involved in cash balance plans is that because they are DB plans, they do come with an annual actuarial valuation requirement and minimum required contribution requirements. This is even though the cash balance benefits look and feel like 401k plans, they still have those DB requirements. So I could probably talk up a cash balance plan all day because I love the safety and security of benefits for our employees. I think that is such a great recruitment and retention tool. I love that they're portable like 401k plans. I love, again, for employees that they have PBGC protections attached to them. But I don't love, from the small business owner perspective, that they have the annual valuation requirement, the minimum required contribution requirements. So I wouldn't necessarily recommend this plan for everyone. We'll talk more in a couple of minutes about who I might recommend this plan type for. But as you can see, it would be somebody, who would be equipped to manage those regulatory requirements that are associated with a cash balance plan. If it is a brand new business, a business that has unpredictable cash flow, a business going through a lot of organizational changes, that might not be the ideal time to recommend a cash balance plan. But if it is an employer with strong cash flow, solid business procedures and solid business setup, this can be a fantastic option that provides benefits far and away above what we can see in a 401k plan. I kind of mentioned this already, but just to reiterate, I think the combo, the 401k cash balance plan, it helps the business owner maximize contributions. Both plans are separate vehicles that can be tested together for compliance purposes. And typically, when you do have the combination 401k cash balance plan, they benefit each other for compliance purposes. So I mentioned several times that cash balance plans allow you to contribute significantly above what our standard DC plan limits are, but here I'm giving some numbers to that. So when we combine plan types, such as a 401k with that cash balance plan, we can really ramp up the amount that we can contribute. This slide is representing the maximum contribution limits in a 401k plan alone in the column on the left. So it's just the regular limit and then the regular plus the catch-up amounts. The next column is showing the limits if a 401k plan has a profit sharing or other employer contribution component. So that's the annual additions limit right there. And then in the third, I guess the fourth column, I'm showing cash balance contribution limits. The last column showing the total if you have a combo plan. So if I am a small business owner and I am 60, if I just have a 401k plan with employee deferrals only, I could sock away 30 grand a year. If I add a profit sharing or employer contribution component onto my pre-existing 401k plan, I'm up now to $73,500 per year. That's a pretty substantial limit. So for many small business owners, a 401k plan with the opportunity to put away almost $74,000 may be sufficient. But I'll give you more examples of this in just a moment. But consider the case, say, of an attorney. And maybe, they went to law school. They may have incurred significant debt to do so. They may have spent a number of years paying their dues and paying off their student debt in the early years of their career. Even though they may have commanded a very large salary during that time, they may not have had a ton of cash flow. But maybe once they're established in their career, again, maybe they're 60 now, they're well seasoned, they go off and they start their own firm. And they do well and they have significant cash flow. And now we have an attorney who spent the early years of their career establishing themselves, paying down debt, and all the things that we do in the early years of our careers. Now, as in this example, this person is perhaps starting to seriously think about retirement and may have to go above the $73,500 per year. Well, in this example, the maximum benefit that could be contributed, cash contribution that could be made to a cash balance plan for this individual for that given year is $280,000. If we have a combo plan, now this person could receive benefits in a single year equal to $353,000. So you can see how that combo plan really ramps up the maximum benefit amount. But again, it's not right for every person, and where it might be right for a business owner at one point in their career, like the example that we just provided with the attorney who went off and started their own firm late in their career and needed to bolster their savings, it might, not necessarily have been right for that same individual earlier in their career. So I think that this chart, hand in hand with the other two charts that we showed, are really powerful in delivering the message to the employers that you may work with in the course of your business. So we know that a cash balance plan consists of a service credit, an annual service credit, which is based typically on earned income, and an interest crediting rate. But I want to talk just for a moment about the interest crediting rate because, I work with a couple of cash balance plans myself. The regs have changed a little bit over the last couple of years, and I think that there are interesting opportunities with cash balance plans as it pertains to the interest crediting rate that you select. So back in the day, pre-Secure 1.0, 2.0, all that stuff, I used to work on some cash balance plans that had a very basic interest crediting rate. It was tied in with some very low benchmark, and plan participants really didn't typically tend to earn too much each year in the interest credit component of their accrual. But the regulations have changed that over the years so that we have a wider variety of benchmarks to peg our interest crediting rate to. I'll give you a couple examples in just a moment. But just in broad terms, when we're thinking about the interest crediting rate in a cash balance plan, this can be a place where our guidance, the small business owners that we work with, can really bring a lot of value. The funds in a cash balance plan should be invested in a way that targets a return that has a direct correlation on the interest crediting rate. So let me put that another way. We've got these two components in our cash balance plan, the service credit and the interest credit. By targeting the asset allocation in the underlying portfolio to align with the expected cost of the interest credit, less cash is needed each year from the employer to fund the plan. In this way, investment results or the selected interest crediting rate can either help or hinder retirement plan outcomes and costs for our small business owners. So as you can see here, 5% is a fairly common interest crediting rate. So there are a couple of things to know about this. If you're using an interest crediting rate of, say, around 5%, you probably want to make sure that your underlying asset allocation is set in such a way so that it can offset the cost of that interest crediting rate. But like I mentioned, with the recent legislation over the years, there are a lot more options for interest crediting rate available than just the standard benchmarks that we've typically seen. In fact, I've seen some plans here at Pentegra, our own plan, for example, credit the rate of return of the underlying portfolio. So for example, here we have an MEDB plan, which is a multiple employer plan for financial institutions. What we do in at least one of our cash balance adopting employers is we set the interest crediting rate to be equal to the rate of return on that portfolio. So essentially, there is no additional cost for Pentegra to fund our interest credit because it equals the return on the portfolio. So don't just consider the service credit, also consider and see if you can provide guidance around the specific interest crediting that is used. The one thing I would say about that, though, is if you have a client who wants something non-standard, it's always a best practice to run it past your ERISA attorney first and check that the record keeper can accommodate such a provision because, as mentioned, DB plans did fall out of popularity for a while. We're just kind of starting to see a resurgence in cash balance plans now that the interest rate picture is changing. So you just want to make sure, that your record keeper can accommodate anything that you would like to do before running it past a potential client. So who are cash balance plans best suited for? I kind of mentioned this already, but they tend to be most popular among our smaller, well-established firms that have significant and consistent cash flow. Owner-only employers, medical groups, CPAs, law firms, financial service firms, consultants, hedge funds, IT, things like that. Okay, we've now come to our first polling question. As a reminder, if you are requesting CE credit, you do need to participate in these polls. I'll go ahead and read this off, then we'll open it up for you to answer. Which of the following are true? A, cash balance plans are defined contribution plans. B, cash balance plans are hybrid defined benefit plans. C, cash balance contributions are not tax deductible. D, cash balance plans are non-qualified.
Polling question will be open for about another 15 seconds. Poll is now closed. Kate, you may proceed.
Great, thanks so much, Jen. And the answer to this question would be cash balance plans are hybrid defined benefit plans. As we said, got the look and feel of our 401k plan with the funding requirements of a DB plan happening behind the scenes. And again, that's why, we love them from the employee perspective because they're portable, people can easily understand them, but we just want to make sure that the clients that we recommend them to are able to handle those additional regulatory requirements along with the annual funding requirements. But they can be just a tremendous vehicle for savings if you have anybody who fits that profile. All right, so we talked about plan type. I think plan type is very important. Again, don't just share those charts and say, what do you want with your clients? Really have those discussions, ask those questions that we highlighted. And that will, I think, naturally illuminate the right plan type for the clients that you work with. Next, what do I need to know about Secure Act 1 and 2.0? you probably remember the Secure Act, which passed at the end of 2019. This law and subsequent regulations created some new plan design options, including pooled employer plans and groups of plans, and it also clarified the rules for multiple employer plans. So we'll talk about those three things, and then it also provided a couple of financial incentives that we want you to know about to share with your clients. So we'll talk about those as well. So the next the next three slides, I'm going to talk about GOPS, PEPs, and MEPs. My gosh, I know that is an alphabet soup. But what you need to know before we get into that discussion is that all of these are, what's the right word I want to use? Arrangements consisting of more than one employer. You also, of course, have the ability to have employers who sponsor single employer plans. And in that case, it is an entity of its own. It is its own plan with its own Form 5500 requirement, its own audit requirement, if applicable, its own non-discrimination testing requirement and things of that nature. I think probably for most retirement plan practitioners, we're probably most familiar with single employer plans. And that's why we wanted to highlight the GOPS, the PEPs, and the MEPs for you today, because they all have certain opportunities for streamlining of services, cost savings, and things of that nature. So if you are a practitioner who has a book of business with a number of different clients, you may want to consider establishing one of these plan types, and it has a lot of benefits. You can get everybody under one umbrella, deliver one message, and a lot of other uniformities that I'll talk about now. I guess the only other thing I would say is, just like with the statement I made about interest crediting for cash balance plans, just always run this past your record keeper, whoever it may be, of course, before sharing the idea with your client. And I'll give you some examples of why in just a moment. So, GOPS, groups of plans. They were created by the Secure Act, and they are available beginning after 12/31/2021. So they've been available for about a year and a half now. Under these rules, defined contribution plans that use the same trustee, the same named fiduciary, the same administrator, have the same plan year, and investments may file a single Form 5500. All these plans in the GOP, they still remain single plans. They all have their own EIN, they all have their own adoption agreements, but there is some cost savings associated with that single Form 5500, especially if it is an audit required large plan. And I think that there is some benefit, if you already, say, have a book of business who is with, one certain administrator, or if you have an administrator that you like to work with, that could be a reason to explore potentially a GOP. Then you have a MEP. So there is a fundamental difference here. The GOPs are all treated as individual plans, but they just, have those commonalities that we just identified. And as a result, they get that one benefit of the single Form 5500 filing. A MEP is like a step above that, because as you can see here under the first bullet point, a MEP is considered a single retirement plan in which more than one employer participates. So the DOL, over these last pieces of legislation, they did issue final regulations that clarified MEP operations. The DOL requires that employers in a closed MEP must be part, as you can see on this slide, of a bona fide group or association with something in common besides co-sponsoring plans. The final rule addresses two arrangements for offering closed MEPs: association retirement plans and professional employer organizations. So up top, we're talking about closed MEPs here where we have something in common. And down below, we're talking about open MEPs where we don't necessarily have something in common. So you can set them up both ways. I know at Pentegra and most administrators, they'll offer it both ways. And it just depends on whether or not there is a common nexus between the groups participating in the MEP. And this, common nexus, this definition of a bona fide group, it's defined. I'm going to rattle off a couple of pieces of this definition to you. This presentation is being recorded, of course, so you may want to refer back to this for future reference. But essentially, in order to be considered a quote-unquote bona fide group, it has to be a group of employers where the primary purpose is to offer the MEP. They have at least one substantial business purpose unrelated to the MEP. So you can't exist, just for the purpose of offering a MEP. Each employer has to have at least one employee. Owner-employees are okay. You do need to have a formal organizational structure. You can't just be, a cart selling hot dogs. The functions of the association are governed by employers. There has to be a commonality of interest. It has to limit plan participation to the association, so the association can't run off to everybody in the community and say, hey, join our plan. And the association may not be a bank, trust company, insurance issuer, broker-dealer, or other similar financial services firm. PEO-based MEPs have similar rules. And, I know I just rattled off a ton of components to this. So just to summarize, what's the significance of all these rules and regulations? Basically, these types of MEPs have been in existence now for a little while, and we never really had clear authorization about specifically what constitutes a closed versus open MEP. Now, these final regulations in publishing these specific criteria essentially give us a safe harbor so that we can have assurance that our MEP is permissible, our closed MEP is permissible, within the definition of the regulations. So again, as I mentioned, this is just another case where you have a group arrangement opportunity, but there are some regulatory hoops that you will have to jump through in order to offer this type of plan structure. But it's not mentioned on this slide, but the closed MEP is very similar to the GOP, where you have the 15500, the one audit, if applicable, but it actually takes it one step further. With the closed MEP, you are considered to be one plan. Well, actually, with a closed and an open MEP, you're considered to be one plan. There's typically one governing plan document that adopting employers, choose provisions from. Typically one or two investment lineups to choose from. So very similar to the GOP, just additional benefits by being considered officially one plan. Now the difference, I will say, again, it's not on the slide, but the difference between the closed and the open MEP, the closed MEP, when they have that nexus, they have the benefit of just one 5500, one audit. If you are an open MEP, and you do not have a common connection or nexus, then you have to have individual 5500s, individual audits as required. I know that this sounds like so much information, but as with everything, I think if you ask clients the questions rather than just shoving this information at them, it will help them better align their goals with the different options. So, for example, if I had a small employer who suddenly became a large employer, was in an open MEP, and now all of a sudden is facing an audit expense, I don't know. Maybe I want to think about setting it up as a GOP so that we can have, the nexus is not required, but we can still have the single Form 5500 filing. So do your clients have an audit requirement if they are a large plan or not plays into this? Do they have a common nexus or other entities or organizations that they regularly work with? Could a GOP be formed around them, or would a closed or open MEP be more appropriate? And typically, the record keepers that you work with are very well versed in these plan structures. I know here at Pentegra, we regularly work on these issues. So, if you had a client and you had a profile for them, but you weren't sure, what type of plan, either plan type or plan structure to recommend, you could always run those demographics past us, and we would be happy to run through the options with you. So here we have yet another option, which is a PEP. So pooled employer plans were also provided for in the Secure Act and were available for adoption beginning in 2021. These new structures allow two or more unrelated employers to participate in a single plan offered through a registered pooled plan provider, PPP. By combining under a single PEP, the PPP files one Form 5500 for the group, conducts a single audit as required, and determines ERISA fidelity bonding for the MEP as a whole. Now, something different exists in the PEP that doesn't exist in the MEPs and the GOPs, and that's the PPP. So a PPP is a person or entity that registers with the IRS and DOL and offers the PEP for adoption. The PPP is designated as the plan administrator and must acknowledge its status as a plan fiduciary in writing. The PPP must also ensure that all plan fiduciaries are bonded, and the most likely entities to serve as PPPs include financial institutions like banks, insurance companies, broker-dealers, registered investment advisor firms, payroll providers, and local chambers of commerce. So we here at Pentegra are also equipped to serve in this role. And remember I mentioned before, well, I mentioned several times, check with your record keeper beforehand. This is a great example of why you might want to do that. So we at Pentegra are able to serve as a PPP on a PEP, but we don't serve as a PPP on every PEP. So if you had a group of employers that you were considering offering a PEP to, we would want to know that before you even went to them. Why? Well, because the PPP takes on some of that fiduciary responsibility and governance role off the shoulders of you as an advisor CPA or off the shoulders of the employer. As you can see here in the last bullet point, no more one bad apple rule, because the PPP is, taking on a lot of those responsibilities. However, we need to make sure that the plan is in good shape, that the employers are suitable, and things of that nature. So we do a lot of due diligence before agreeing to serve as a PPP on a PEP. So the PEPs are good if you have an existing relationship with a PPP and you want to kind of streamline things and offload some of that fiduciary responsibility. The MEPs are good if you have a group of related employers. You get a lot of benefits, but unrelated employers can still offer them with slightly less benefits, but still some. And then the GOP is good for people who, say, what, I still want to be a single employer. I want to have a little bit more control, but I'll adopt these streamlined features in exchange for some benefits. Okay, so I also mentioned, in addition to the plan structure changes, there are also some new financial incentives as a result of the recent legislation in Secure 1 and 2.0. So I'd now like to talk about 3 different types of these incentives that are now available. First off, small employer plan startup costs. Now, there were rules around this previously. As you can see here in the second to last bullet point, the prior rules still apply for those with 51 to 100 employees. This is a tax credit specifically for 50 or fewer employees, which is why we wanted to highlight it today in the discussion around small business owners. This tax credit is increased from 50 to 100% of costs. It's capped at $5,000 a year for the first 3 years that a plan is in existence. There's also an additional credit for employer contributions to the DC Plant 401k plan, up to a per employee cap of $1,000. Now, it is phased out for larger employers, but it applies to new SEP, Simple, and 401k plans, effective for taxable years beginning after 12/31/2022. So brand new in 23. Another one that's brand new in 23 is the small employer military spouse credit. Small employers can get a tax credit for their DC, for their 401k plans, if they follow these criteria. Allow military spouses into the plan within 2 months of hire, make military spouses eligible for any matching or non-elective contribution that they would have been eligible for otherwise at 2 years of service, and grant 100% immediate vesting in all employer contributions. It's a credit up to a maximum of $500 per military spouse. It is broken up into a couple of components. The credit applies for 3 years for each military spouse, and the employer can rely on self-certification to minimize, the hurdles of approving individuals for this feature. The last one, this one is actually near and dear to my heart, is small financial incentives for contributions. Prior to this role with Pentegra, I used to be an employee education consultant. So I used to travel the country and, help explain retirement plans to people and encourage them to participate in things of that nature. And it was always the old, you can lead a horse to water. But I noticed that whenever I was able to do things like have a pizza party, lunch and learn, a little game or whatever it may be, miraculously, more people always showed up to my meetings. But we could never offer gift cards specifically to incent people to contribute. So I could have given a Pentegra gift card to, for Amazon or whatever for $10 if somebody answers a quiz question right. But I could never say, here's a gift card if you participate in the plan or if you participate at XYZ level. But now, effective for plan years beginning after 12/29/22, we can offer small gift cards or things like that. Caveat, can't be paid for with plan assets. But I think for plans who have a low participation or plans who are considering offering employee education in 2023 and beyond, that might be something that you want to look into. Because in my experience, those incentives definitely work. And, typically the benefit that they offer costs less than the cost of offering the incentive. You give somebody $10 for participating, and now, maybe you've got a lifelong saver. I think there's a big benefit there. Okay, I'll get off my soapbox about saving. We've got 13 minutes left and 2 more poll questions to get through. So I'm going to go through a couple of these slides quickly. The legislation also provided for starter 401k and 403b plans. This is important because a lot of states, as we're seeing now, are starting to enact mandates, as I'm going to show you on the next slide. But this is effective for plan years beginning after 12/21/23. So after this year, this is a federal program permitting an employer without a retirement plan to offer this starter plan. All employees, though, must be automatically enrolled at a specific deferral rate, at least 3% of compensation. And there are lower contribution limits than we see with the regular standard 401k plan. I showed you those earlier. Deferrals here are limited to the annual IRA contribution limit. But, I think that this is a good first step for an employer who either wants to offer a plan but hasn't, had the opportunity to yet, or potentially for an employer who is subject to a mandate. And I think this is the last one under the legislative changes that I wanted to share with you. Retroactive first-year deferrals for sole proprietors. What this is letting people do is if you're a sole proprietor or a single member LLC, you can make employee contributions up to the date of the employee's tax filing date for the initial year. Now, this is just new in this year, in 2023 and later years. And, I think that this is a really useful feature for our sole proprietors, especially those who have variable income or are in a situation where, as you can see, you're in the initial year. You might not necessarily know what your expenses are going to look like around the plan. Is there going to be testing issues, refunds? Who knows? This lets you kind of suss it out, get a sense for how things are looking, and then gives you the opportunity to make a retroactive first-year deferral if you choose to, which I think is fantastic. Oh, I lied. I'm sorry. I actually have one more, which is the Rothification, essentially, of certain types of retirement plan components. Now, this is another one that I love. We can now designate contributions to simple and SEP plans as Roth, effective in 2023 and later years. And we also now have the option to treat match or non-elective contributions as Roth in our platform-based qualified retirement plans, effective, again, this year. The benefit of this, I think we all know about the power of Roth will never have to pay taxes on that money again. It has certain, more favorable distribution requirements in certain situations. But I don't think that this is a silver bullet. You would need to amend the plan for this. So if you have clients who are interested, again, just make sure the record keeper can accommodate it on the document that you're working with. And the other consideration is that there's no free lunch in this world. Roth employer contributions would be taxable to the employee at the time that they're made. So it would increase the employee tax burden in, that year that they received Roth contributions. But definitely something to think about as we think about best practices in plan design going forward. Okay, time for our second poll question. Secure 2.0 changed the plan startup credit in what way? The law eliminated the plan startup tax credit. A. B. Increases the tax credit from 50 to 100% of costs. Or C. Creates new tax credit for employer contributions to DC plans. And D. Both B and C. We'll give you just a minute to answer that.
The poll will be open for about another 10 seconds. The poll is now closed. And just a reminder, in order to get the full credit, you need to respond to all 3 polling questions. The last one will be launched before 3. Kate, you may proceed till 3 o'clock. Thank you.
Thanks so much, Jen. The answer to this one was D, both B and C. And we have 8 minutes left now, and I have 2 more topics to cover. So that's going to be plan mandates and a little bit about limiting liability when it comes to small business owner retirement plans. And then we'll close out with our third poll question. I mentioned plan mandates. A lot of them are coming down the pipeline. That's, again, why the starter 401k plan was provided for in Secure 2.0. This is just a visual about who is offering mandates and kind of what the status is with the various states. So the red states are people who do have mandates. The yellow states are people who have, Washington is a state with a marketplace. The yellow has a state MEP available. The blue is a marketplace or an IRA option. And then the green is kind of TBD. We're still seeing what's going to come out of those states. But the trend is mandates seem to be the future of the retirement plan landscape. All right, last topic, and then we'll do the poll. How do you limit liability related to our small business owner retirement plans? There are a lot of different elements of plan governance here that I'm going to run through for you over these last couple of minutes here. Selecting and monitoring plan service providers, investment oversight, plan document compliance, fulfillment, reporting, notices, disclosure requirements, and conflicts of interest. So in a sea of different liability issues, there are 3 types of fiduciary responsibility that you could potentially look to: 316 administrative fiduciary relief, and then 321 or 338 investment fiduciary relief. So just a moment on each of those. We have 2 other governance items here I didn't populate. I apologize. 316 services are the administrative fiduciary relief. So that is the entity who is going to make sure that the plan is in compliance from an administrative perspective. Are distributions being processed properly? RMDs, cash outs? Are people entering the plan when they're supposed to enter the plan? Have there been any missed deferrals? Is the plan document in compliance? All of those administrative nuances. It's certainly not required that you have a 316 service provider, but as you can see here, the DOL more and more is recognizing that it's a valuable role and encouraging service providers to, take some of that fiduciary responsibility off of employers' plates. The other one, just for time purposes, I'm going to show you here. Here's an example. I already listed these of the 316 fiduciary services that may be outsourced. And then we have investment fiduciary responsibilities. So 321 and 338. 321 investment fiduciary is, I'm going to give you recommendations, but I'm not going to make changes on your behalf. 338 is, not only am I going to make recommendations, but I'm going to take the onus to make changes on your behalf. So typically, as you can see here, this is somebody who has full discretion for plan assets, usually is an RIA, bank, or insurance company. And I know here at Pentegra, we fulfill this responsibility, and we do a lot to take the liability off of employer and advisor plates. We do quarterly monitoring. We have a watch list system where we look at all investments and rate them based on 8 criteria. We have protocol in place where we have a select list that has pre-vetted and approved investments that are suitable for retirement plan fund lineups. So there are a lot of reasons to consider adding either a 316 and or a 338 or 321 investment manager to the team of experts working on these plans. This is a look, again, I just mentioned kind of what we do as a 338. This is just a visual of that process. Evaluate the investment universe, look at fees, look at the service agreement and investment policy statement and maintain that investment policy statement, and then monitor on an ongoing basis. Okay, it's time for our last polling question. The following are co-fiduciary offerings that are available for business owners to help manage plans and reduce risk. A, 316, B, 321, C, 338, or D, all of the above.
The poll will remain open for about another 10 seconds. The poll is now closed. Kate, you may proceed.
Great, thanks so much. The answer, of course, is D. All of these are co-fiduciary offerings that may be helpful to small business owners. Okay, so we have 3 minutes left. I said that was the last topic, but I actually do have one more. I just wasn't sure if I was going to be able to get to it, but it is my pet topic, which is non-qualified plans. So since we have this time, I will go as far as I can go until we get to 3 o'clock just to cover this topic, because business owners want to take care of their key employees to ensure longevity of the company. When key employees are already maxing their qualified plan benefits, as we discussed earlier, it might be time then to talk about the next level, which is non-qualified plans. There are 4 basic categories of non-qualified deferred comp plans that you might want to consider with your clients. Salary reduction arrangements, bonus deferral plans, supplemental executive retirement plans, or SERPs, which are also called top hat plans, and excess benefit plans. So which plan is right? I always recommend first considering the type of benefit you'd like to offer in hand with who you'd like to offer it to. For example, SERPs are for a select predetermined group of management, whereas, say, an excess benefit plan targets those who are limited by complements. So, again, it's easy to get kind of overwhelmed by those 4 different options, but by asking the question of what are our small business owners looking to get out of this plan, we can better target the right plan structure for them. And the same applies to financing these benefits. So there are 3 basic options for securing benefits for non-qualified plans: pay-as-you-go out of working capital, a sinking fund where assets are earmarked but not held in a retirement trust, and institutional management. I think that all of them have their pros and cons. Perhaps another time we can do a webinar diving into these 3 options. If there's interest, we'd certainly be happy to. But in the meantime, I'll close out with one final note, just on special considerations on pass-through entities for non-qual plans. So for businesses that are pass-through entities, earnings and losses pass through to the owner, who reports them on their personal tax return. Contributions to a non-qualified plan would be pass-through earnings, to the owner. Plus, earnings on non-qualified plans are taxable to owners as they accrue. So because of this, non-qualified plans probably aren't appealing to the owners themselves of pass-through entities specifically, but non-qualified plans can be effective, really effective, in incenting and rewarding non-owner key employees in certain business structures. All right. At the conclusion of this webinar, there are also some financial wellness resources, which we would highly encourage you to check out as well. So we'll make sure that you have access to those. With that said, I think we've about hit 3 o'clock now. So Jen, Lizzie, I'll turn it back to you for any questions and to close us out.
Great. Thank you so much, Kate. As of right now, I don't see any questions in our question box. So as a reminder for everyone, please complete the survey questions that will pop up on your screen in just a minute. You will receive a link tomorrow for today's broadcast. Thank you, everyone.